And thanks for hanging around. You know, the last panel of the day is sometimes sketchy, but it looks like we got a lot of people, and it's better than the 8 a.m. hangover panel, right? We avoided that dilemma. When we put this together, we wanted to compile a group of people who represented a broad variety of capital types. So let me introduce the panelists. Stanley Alterman is from USAA. That's a good wave, Stan. Good wave. Stanley is really a insurance company advisor, pension advisor, so we thought it was important to have that capital stack. And Stanley now runs all portfolio management for
asset management.
All asset management for USAA. I'll get it right one of these panels, Stan. Next is Nick Anthony from Duke Realty, the public REIT space, the chief investment officer. Thanks for coming, Nick.
Thanks.
We also decided that no panel was really complete without in-depth expertise on global capital, given what's going on in the business today. So we've got Chris Chang from Goldman Sachs. Don't ask Chris any hard questions. He just sold Cushman & Wakefield, so I need to be really nice to him. So softball questions for Chris. And down at the far end, Matt Brodnick from Exeter was unable to attend due to a pending transaction. So we have Tom Wong from Exeter, who's a partner in the Northern California office of Exeter. And since we referenced foreign in the introductions, probably a good enough place to start. You know, I made a little list of notable transactions over the last 15 months that's really kind of unprecedented in my 25 years. You know, it started off with IDI being sold to Brookfield. Incor was sold to GLP and GIC. KTR is now in the hands of Prologis and Norgis. Cobalt was sold to Colony Financial. TA was sold by Rockefeller, which is, you know, ostensibly Mitsubishi. And, you know, Cushman & Wakefield was acquired by DTZ.
Closed?
Going to be acquired. Thank you, Stanley. Subject to regulatory approvals. You know, which is essentially a global capital consortium led by TPG out of Australia with capital partners from Canada and Asia. And it's a new thing, right, for all of us to have all of this international capital in our space. So I thought I'd really start with Chris. If you could kind of set the table at a high level, you know, why are we seeing so many foreign investors in the United States in general, and what's changed that makes industrial an attractive asset class to them specifically?
Sure, thanks, Jim. So I'm based out in San Francisco, and I'm in the real estate investment banking division covering the West region. And as Jim mentioned, I did work on the transaction selling Cushman & Wakefield to the foreign capital providers. And I think what we're seeing in the industry today, and it's a bit different from several years ago, you know, one is the amount of capital that's available. If you kind of take a look at just kind of one example, you know, take Norgis, for example, when they say they have a 5% allocation to real estate. Well, they have $800 billion under management. So you're talking about $40 billion of capital they want to deploy in this sector, and that's just one entity. And you can kind of take that example, go through kind of across the globe, in Europe, in Asia, in Canada, and I think you see increasing allocations to real estate across the board. And I think when you take a look at what region they want to deploy it in, they increasingly look to the United States for that, and a lot of it has to do kind of with our economy being a bit more robust than other regions. So I think on a risk-adjusted basis, they definitely see the opportunities there. And the other kind of shift that you see in terms of not just the amount of capital, but kind of where they're looking to deploy it is, in the past, they were focused much more on CBD areas, certain asset types such as, thank you, certain asset types such as, office, nice shiny buildings that they could show off to their colleagues. But I think you're definitely seeing a big shift towards other asset types such as industrial. And once again, that's also kind of driven by where they see on a risk-adjusted basis the opportunities. Most of these investors are searching for yield right now. It is a yield-starved world, given kind of where interest rates are in the U.S. as well as in Europe. And I think the other kind of big kind of change in terms of looking at certain asset types that are different than the past is these institutions have becoming much more sophisticated, whereas in the past, they generally look to co-invest with certain parties. Today, they've actually opened up U.S. offices. They've built out their investment platforms in the U.S., and they can underwrite these deals on their own. I think Jim cited the Incor transaction where GIC did all of the underwriting in-house, and they tied that up on their own without having to kind of work with anyone else on that deal. So I think that in terms of what we are doing now, and when we have large portfolios to market, we go and one of the first calls we make are to these international capital providers, and we tried to reach out to them much sooner in the process because they still do move a little bit slower, but given what they're willing to pay for things, I think you have to talk to them, and you could argue that their cost of capital is also significantly lower than some of the domestic players out there. Especially if you look at the public REIT space when the implied cap rates that these companies are trading at are at, or you could say are discounts to private market valuations. The international private guys are able to outbid on assets, and you can see the last couple of trades have been highly influenced by the foreign capital.
So, and everyone here has probably done something with a foreign investor. Stanley, we can't talk about who he's done a transaction with. You've told me multiple times. I'm still not going to say it. But Stanley did a very large transaction involving global investors from two different parts of the world last year. What's it like to transact with those entities, and is it different in terms of the transaction process itself? Talk about the need for a different kind of relationship in the transaction process.
Well, it can be more complicated because the foreign investors have different goals. One, he mentioned they're going for yield. I think a lot of foreigners, not necessarily the ones that invest with us, but they're looking for capital preservation. And they're looking at alternatives. They're concerned about where they want to invest. They love the United States. They're looking long term, which is a big change from the past. Not necessarily looking at a 3 to 5 year horizon. They're looking very, very long. So that's a big change. Tax issues drive many of the structures, so that can be very complicated. So that's a part of it that's different. The one thing I would add to the overall real estate market is one of the biggest factors is capital. There's so much capital, so it's making the market so much better than it would otherwise be. It's not just foreign, it's domestic and foreign. And I don't think you could underestimate how important that is.
So what does that mean to Duke, Nick?
Well, we've seen it like everyone else. We've seen it on big transactions and small transactions. Obviously, it helps us prune our portfolio at this point in the cycle that we wouldn't ordinarily have been able to do. These foreign investors, they like the industrial space because it generates a good cash yield. There's not a lot of capital like there is on the office side. So we've seen it that way. The one thing that concerns us a little bit is they are long-term investors, and they will likely hold these assets for 30 years. And so these assets won't be available again for quite some time probably. So that is going to have some impact going forward. I think right now it's just a perfect storm with the aggregators out there like Exeter and USAA and Cobalt and KTR have put together these nice portfolios, and now they can get big slugs of capital out. So it definitely helps us from that perspective as far as executing on our repositioning strategies going forward, but we are concerned about the availability of assets going forward.
That's actually a great point. That's why you've got a C in your title. The CIO has the great points. But I think the holding period question is very pertinent in that where you're seeing 15 to 20 year holding periods, and I think that's probably true for some of the open-ended core funds these days too. Whether it's AEW's fund or J.P. Morgan, they're looking at much longer time horizons. But the world, what's the old saying? Trees don't grow to the sky, right? This market won't continue forever. And when the 10-year inevitably rises, above 3, an alternative. Let's be honest. We're an asset class that's an alternative to other things. Mm-hmm. The question that I'd throw out to the table, anyone, to respond to, when alternative asset classes become more attractive, how fast does this capital leave the space?
Yeah, I'll hit that. I think the real estate has become an accepted class, and that wasn't true 20 years ago, probably not true 10 years ago. So I don't think that's a major fear personally. I think people are committed to real estate. They will continue to invest in real estate, and I don't think that will change.
But we've had 5.5 straight years of net positive inflows into the core space and probably 3 years of net positive inflows from global, you know, in a world where I think Chris referenced earlier the European bond yields are 0 or negative. From a capital allocation standpoint, Chris, you know, do you think if alternatives look more attractive that these sovereign wealth funds just move into the next space? It's got to reduce the allocations to industrial, right?
You know, I think that the investors, you know, cycles move, and you know, when you see all this capital moving towards, you know, industrial, obviously you're going to push yields down to a point at which the risk-adjusted returns are going to be different in terms of the spread relative to other asset types. So I think there could be, or on the long term, some change. I don't really necessarily see that in the next year or two, but no, I think it's reasonable to assume that, you know, as more capital floods into, in particular, industrial, it could have an impact on that.
Yeah, it's going to
Tom. I'm sorry.
Go ahead.
No, that's fine. I mean, I will say one thing that really influences, I think, everyone in this room is the characterization of the industrial space. You know, historically, it's never really been in vogue, and the extent to which, you know, the binary risk associated with an individual asset has been offset by large portfolios, right? You have the diversification you used to find in multi-story office buildings with, you know, diverse rent rolls. Now you have that in large portfolios, large slugs of capital, and, you know, that appeal, you know, everything about industrial that we all fixate on, right? It's long-term credit in place, low churn costs, you know, all of those, you know, features, I think, are enduring. And I think, you know, the allocation to the industrial real estate sector will remain. I mean, many people focus on the fact that, you know, real estate's an inflation hedge, right? And that dollar-denominated assets are attractive for international investors. So the extent to which you have that, you know, direct foreign investment into industrial real estate in the U.S., I feel like it'll stay in place.
So I'm going to ask you to stay in the spotlight here for a minute. So not everyone in the room has $3 billion worth of assets to sell.
Correct.
Right? So what does this capital flow mean to those of us that don't have $3 billion portfolios? Do you think these investors are going to continue to move into smaller transactions given their new operating capabilities? What does it really mean for something other than someone who has $1 billion to sell?
Well, I'll speak first to the groups that have the billion or more. It's becoming more and more crowded, right? You look at that portfolio premium associated with the, you know, portfolio we have on the market, the portfolio that KTR sold, that everyone before them did. It's massive, right? And the cap rate at which these portfolios are selling are staggering. Many people, right, at this table, manufacture those portfolios, right? We do one-off transactions. We do, you know, small, bite-sized transaction, aggregate them into, you know, liquid core portfolios. And something that we've learned in the process of marketing, you know, the $3 billion sale is you don't know exactly what they want. You know, we fashioned a 55 million square foot portfolio that we thought was optimal for disposition to sovereign wealth. We were wrong, because each group that came to the table had a unique view as to what they wanted. Some of them came and said, we want more meat on the bone, right? We want vacancy. We want development pipeline. Because in the same way that all of us are underwriting acquisitions, and that suit that we wear continues to get tighter, right? The rental rate growth that we have to use as a plug, how real is that debt plug that you use? What is your exit cap? All of those variables are getting thinner and thinner and thinner. We have very little latitude, you know, to move in our model. So, you know, I think on the acquisition side, the inefficiency or the space where the guys that don't have $1 billion to spend, it's through execution, right? You know, you focus on your core competency. That may be leasing, that may be development, it may be entitlement, right? That's where you execute, you know, according to your skill set. And large aggregators, or rather the guys that are looking to spend $1 billion, aren't going to execute on a $5 million transaction. They're going to focus on the $1 billion buy.
Yeah, just to add to your question, most of these large transactions, they want to put money out, or they want to continue to put money out, and most of these transactions have an operating platform. So I would expect them to continue to buy smaller projects. Now, they're not going to spend $5 million, but they're going to buy one-offs through their operating platform. So I don't think that will significantly change.
Oh,
Yeah,
go
I
ahead, Nick.
think it's relative. This is what is a small transaction. You obviously can sell the small assets to the aggregators going forward, but we've seen transactions as small as 80, 90 million, 150 million, and we've seen foreign sources be very competitive.
Yeah, we've seen that as well across the country, and there, in the Southeast and Florida markets, we see a lot of South American capital. In the West Coast, we say Asian, and the Europeans are kind of everywhere. And I think I'll close it off by saying it might be transparent to those in the room, but there's probably an international investor somewhere in the capital stack in every deal. Right? They're there even if you don't see them, which has a lot of impact on pricing. And everybody loves the low cap rates today, right? If you're a seller,
Great.
right? But let's talk about that. Not only do you have all this foreign capital, the core, open-ended core funds are raising money in incredible volumes. We track our top 35 customers in the industrial space on an annual basis, and those 35 customers have $17 billion in acquisition targets for this year alone, with a total capital availability of close to 40. And that's kind of weighted 60-40 value add, 40% core. So there's tremendous capital all over the place. Do we think that there's more room for cap rates to drop further, and how does that room for compression vary across the risk spectrum? Let's start with Tom. Sorry, Tom.
No, it's totally fine. I would say that, for us, in terms of sort of segmenting, risk spectrum versus, what we're targeting, value is trading at core pricing, right? Core is trading at, I don't know what it's trading at, but it's unfathomable often. And so, again, the value is defined by the underwriting and the moves that you make in your execution. So, in terms of our risk tolerance, I think, we're arguably looking in some markets that other people aren't willing to play in. We're looking at asset profile that other people aren't necessarily willing to play in. And I think the shift, it may be from, pools of existing asset where I think, execution risk is limited. They tend to trade more efficiently. Our preference is for complexity, hair, and scale appropriate, meaning inefficient only because transaction size may be too small for others.
That's a very political answer.
Like that?
But our core cap rates coming in more, our value add cap rates coming in more. Where do you think?
Value is coming down. And again, because I think in the underwriting, people are getting more aggressive in terms of what they're claiming their stabilized yield is going to be. So going in, I think it's coming down. On the core side, it's market by market. I don't know if there's much runway here.
Yeah. I think there's a little bit more room to. The spreads are still. It's been mentioned a couple times. Spreads are still very good compared to where they were in 2007. I think the spreads are 350 over the 10-year Treasury, maybe 300 now. They historically run around 200. So there's probably some room to run a little bit. But as these rates start creeping up, there's going to be more and more pressure, and people are going to start scratching their head and thinking about the cap rates now that rates are really moving. And now we're finally seeing that. But the other side of it, though, that arguably rent growth has been tremendous. Our portfolio is 96% leased, and we had 7% revenue growth, rent growth in the first quarter. So that's going to offset some of that too. So I think I don't know if it's going to compress anymore. We keep saying, every time we come to one of these conferences, we say it's done.
Yeah.
And we come back and they've compressed some more. So there's going to be some more pressure pushing them up, but I don't see a big jump going forward.
Go ahead, Sam.
So it's very difficult to predict where cap rates are going to go in individual markets. But I just saw a statistic from RCA CPPI, and it said that we reached the peak in March of 15. And it said that the major markets are 16% above the peak, and non-major are 10% below. So that's just a data point to think about. I also think people may emphasize interest rates too much. I still think the amount of capital is very important. And the other obvious important aspect is the economic metrics, supply, demand. And we are very stable right now. We have construction, but we have very positive. We've had 20 months of positive absorption. And so it's still very, very stable. So I think there's I think that I don't see a lot of movement either way personally. But I think it's, at this point in time, it's very stable.
Yeah, we have seen a remarkable amount of discipline across the quality spectrum, right? We haven't seen really the B-minus product come in a lot. Whereas the quality stuff, I think, has come in about as far as it can, unless people are really going to underwrite rent growth beyond, 3 to 5 year period, which will drive cap rates down. So let me close off the interest rate. You touched on the 10-year. Chris, where was the 10-year yesterday? Do you know?
Actually, I don't. Sorry, but
You're the
I can
banker on
tell
the panel, dude. What's up?
It's something where interest rates, people have their own views on kind of when they're going to go up, right? And I think our economist, originally it was going to be, sometime at the beginning of this year, and we've certainly pushed that out a bit. And I think the general rule is, even if it does move up, you're talking about a 25 bip movement when that happens. I don't think that's material enough to really change, valuations, and any type of increase in the long term. It's going to take a while for it to kind of get back to where it was several years ago. And like Nick said, I think there is room for more compression between the spread. So I think that while the cap rates may not compress a ton from here, I don't think it's going to start expanding just when interest rates start moving. I think that's overblown.
Yeah, and I think there's a lot of talk, and I've seen some studies on it where fundamentals trump interest rate increases when we come out of these recoveries. So a lot of it depends on the property fundamentals. Obviously, the REIT stocks get killed every time rates go up, generally, but that doesn't necessarily happen to the private market pricing.
Yeah, the only caveat I would add is, remember, what was it, August of 13, the 10-year poked up above 3, and it got quiet, right? So I think, that kind of, you start seeing the 10-year creeping above 3, I think you'll see some backup a little bit.
Yeah, just going back to a statement that Stanley made, the offset to incremental growth in the interest rate is that international capital. I mean, it's just staggering the extent to which it's, accelerated in just the past 24 months or even 12 months. That seems to zero it out almost.
So
Almost pushing the
we
other
talked about pricing being at peak, right? Or past peak. And I think we probably all agree that pricing is at peak levels from the past cycle. And you're seeing core assets now trading 20, 25% above replacement cost, right? Is that a good thing? Just an open-ended question.
Not for our company.
It's great when you're developing and selling.
Right.
But the price it's interesting, particularly in a lot of secondary markets. There was always this cap on price per pound. Indianapolis, for example, was always about $45 a foot. Now the new 55 or 60 is the new 45. So we've seen that increase across all the markets. Columbus the same way, and even clearly out here,
Right.
Price per pounds are, even eye-popping for even the people who have been out here for a long time. So it is something that I think, as investors, you have to pay very close attention to where your cost is, and make sure you're going to be comfortable with it for the long term.
Well, every one of my OMs swears that we've never sold a building at greater than 92% of replacement cost.
Of course.
So
Of course.
you gotta be
And
careful with
developers
that.
never make any profit
No,
when they
there's
sell
no
their
developer
assets.
profit in any deal ever. So let's close off this dialogue. I think we have a consensus here that, while rates may rise, we have a lot of room to run, and that the underlying fundamentals of the business probably trump the rate increases. Is that a fair consensus? Is kind of the take? Got it. So we've talked about spreads, we've talked about compression and cap rates. Where do you think A versus B spreads are, and where should they be, Nick?
I would say they're probably 75 to 100 basis points, maybe 125 basis points, depending. The question is, what is B? No one has any C assets apparently, so everything gets lumped into this B. So there can be a big disparity. I do think that gap is compressing as there's less and less product available, but I'd say probably 75 to 125 bips.
What do you think, Tom?
I would agree. I would say I love be on the sell right now, but I don't like it on the buy. The danger in all of this is functionality of the asset long term. So if you don't know how to lease space and the market gets soft on you, you'd be left with the dog, which is dangerous. Like again, characterizing what B is. In infill locations, everything is A. It doesn't matter how functional it is. We spoke to a large user that is doing that last mile delivery, and they're on the 3rd floor of a multi-story office building for distribution. I mean, they'll live with what's there. So, the spread is there. It's thinning, surprisingly, because again, people are underwriting more aggressive rent growth, and B, it's generally more heavily multi-tenanted, maybe less credit. So again, people are putting some blinders on, I think, both with respect to functionality and credit, that I think becomes dangerous.
Yeah, and it's certainly tighter in the high barrier infill
Right.
locations
Yep.
than the low barrier markets.
Yeah, I would add that if it's an A product in a B market, that's doing better than others.
Yeah, I think that's a fair assessment. We've seen, this is a year where if you have core real estate and you think rents are rising, you're highly unlikely to part with it, right? There's not a lot of trading of best of the best out in the world. So we're seeing, a wide range of quality in the offering calendar. And, we've found the limit of B in many markets, which is often a difficult conversation, right? As an intermediary, we have to say, we're really sorry, but you do in fact own a C building, right? Those tend to be short meetings occasionally. But I think, what we've seen is if it's under 22 feet clear, if it's over 15% finish, and if it's got metal, you're out of the B box. You just are. And that's unfortunate, and that's life. If you have some assets that don't fit that are aggregated in a park setting or in an infill location, you can probably get away with it. But, there's been a remarkable level of discipline on behalf of the investors in terms of function, which I think that's different in this cycle, whether it's the publications of organizations like NAIOP who have told people what a good building is. But I really think the investment community has done a much better job of understanding what buildings will rent
I
and
have
what
a question
don't.
for you, what you just said. You said over 15% finished. I mean, an Amazon project has so much specialized use. It's still an A building.
Yeah.
It's over 15%. I don't know, do you mean office or what?
Yeah, office.
Okay.
I think, high levels of office. We've even, although it is a sure sign of the market, we've had 2 phrases come back. Buildings unencumbered by leases are starting
Sometimes
to
that's a
trade
good
pretty
thing.
well. And we've had 3 investors ask us, what we thought of flex. So when you see phrases like buildings unencumbered by leases, and you see the value money starting to move to flex, that's a little toppy. But again, I think a lot of that's offset by what we're seeing in the leasing market. So let's move from kind of the capital side to the operating side of the business. I ran a few numbers on construction, and we'll move this into development of fundamentals. We track 38 markets of about 13 billion square feet in the aggregate across the country. In 2014, those 38 markets reported 160 million square feet of net absorption versus construction of 105. And the first quarter was again about a 1.5% ratio, net absorption outpacing construction across the 38. In the top 10 markets, it's still pretty close to those numbers. Peak construction in our universe was 140 million feet in 2006, and spec was 5 times the build-to-suit volume. 2015, we were forecasting about 120 million feet of deliveries, and spec is only 2 times build-to-suit volume. So in that environment, we're seeing development spreads come down tremendously. Do those fundamentals support the compression in spreads and development? How do you feel about the relative risk-reward of building in light of those fundamentals versus other things you look at?
Looking at me.
I'm looking right at you, Alderman.
So, as a company, we think the spreads for build-to-suits have gotten very, very tight and very difficult to make sense. So they've gotten very thin. But there's still, I had a little bit different numbers. So I had, in 2014, 125 million built. The average is 200 million. So it's still a lot less new construction. That's a really important fact.
Right.
And it continues to be the case. In 2010 through 13, there was only about 43 million square feet. So there's a lot of room for additional construction. I think a lot of it has to do with e-commerce. There's a lot of companies that are trying to reposition their supply chain, and so I think you will have to continue to see new construction. We as a company have found it easier it makes more sense for us to build speculative than build-to-suits, even though we love to do build-to-suits. So it again depends on particular market and opportunity.
So if build-to-suit spreads are 0 to 25, which probably doesn't pay you for interest, look at Nick, are they 0?
No. I hear the 0 to 20. I think they're still 50 to 75 bips. Now
On build-to-suits?
on build-to-suits, yeah.
So-
I don't think they're that
So
far.
Lang Allen, who's the head of our development, he told me
You're on the spot, brother.
He told me it was 0 to 50 basis points for
Right.
build-to-suits.
Right.
Yeah, I mean, historically, our development, we've achieved, mid-teen to high-teen margins, which converts to 100 to 125 bips. We clearly have come down from that. I think the difference, though, is that we have all looked like geniuses because cap rates continue to compress during the development cycle. Now we're getting to the point where how much cap rate risk do we have going forward as we build these? Because that's the bigger thing, is because people really feel like if we're getting to the bottom here, we're taking a lot more cap rate risk going forward.
So if build-to-suits are, and I think, where's Olivera? Steve, have you seen a build-to-suit that offered you 50 basis points in the last year? Steve's with Prue, by the way. He's their industrial guy. Yeah. So,
Yeah, that's a good point. I guess I'm looking at it from the perspective, we have a $500 million land bank, so the margins are probably a little bit better on our side as we're looking at some of this stuff.
I mean, you don't mark your land to market when you put it in a deal? God damn.
We do.
And it's hard. I mean, it's hard to generalize. If it's a strong credit, obviously the spread's gonna be lower. If it's in a
Right.
inland empire, it's gonna be lower. If it's in Kansas City, it's gonna be higher. So
Right.
it's hard to make generalizations.
Right.
Depending on the lease term, depending on the lease bumps, there's a lot of factors that go into what the ultimate pricing is gonna be.
Sure, but if you're in a top 10, top 20 market, with a reasonable credit and a 5 to 7, 10-year commitment, it's tight.
Oh, yeah,
It's
it's definitely
real tight.
tighter historically, but
So how does that compare to, and that margin's probably half of what the historical average is today. What about spec? Is that below 100? Look at, he's smiling. On mark-to-market land for a good spec.
market land, it's tightened up. It's probably 100, maybe 75. Obviously, it depends on the the rental rates and that sort of thing. But yeah, it's tightened up.
What do you think, Tom?
Yeah, I think about the same. I mean, again, it all depends what you're using as your plug, right, for your exit and how conservative you're going to be on it. I'd say that there's a slight gradient as you head, smaller in the size of the asset. You have, greater ability to recoup it in terms of the rental rate. I mean, what's interesting is that we went through a period of price inversion from smaller bay multi-tenant and bulk, where bulk outpaced everything else, right? And you achieve price parity, you achieve price inversion. Now the pendulum's swinging back, and now you're beginning to see that rental rate gradient. And so while it costs you 15% incrementally more to build a 150,000 square foot building as opposed to a 400, you're getting it, you're making it back in the rate. So identifying the highest and best use for the site is really where we're at.
Yeah, I think of the 120, again, the difference between your number and ours is we're probably not talking about the same markets of those development volumes, but of the 120 million of deliveries we think are underway for this year, 80 million of that is spec, and of that 80 million, 32 is over 500,000 square feet, right? So roughly 40% of the deliveries are over 500,000 square feet. Have you started to see an increase in volume in the smaller bay space on the development side? Do the numbers pencil now? Tom?
I mean, that's what we're building. We're building a lot of it. So in those markets where we see, good multi-tenant activity, between the 50 and the 125,000 square foot range, depending upon the market, we'll build it.
And what markets are those all West Coast
we're going
markets?
vertical. I mean, right now in South Florida, we've got 200,000 footers going up in Salt Lake, redeveloping a 260 in Denver right now. We're looking to go vertical maybe on some infill 100, 150s in East Bay. So again, in those closer in locations where everything that we talked about earlier today in terms of the last mile deliveries and catering to that segment of the population, we see opportunity there and the ability to really push rents.
Yeah, I would just add that in the smaller bay product, traditionally they've had higher rent growth. That's been their way they've been successful. But this cycle they haven't. And so I think there's the opportunity for it to start growing again. So we like the small bay. We think there's some opportunity to build. And there's a lot of older product that in the small, and because of e-commerce wanting to be close to the population, I think there's going to be more demand for high quality product. So I think there is some real opportunities through rent growth.
Where's Ben? What do you think about this last mile? Ben is, I'm risking sounding like a Cushman & Wakefield commercial, but we just hired Ben, who is one of the heads of real estate for Amazon. And we've had 3 or 4 references on the panel to, last mile. Is that a sea change for us? I mean, do you think there's going to be a ton of those delivered across the e-commerce space?
Yeah, I think it's a sea change. There are going to be way more last mile depots or that smaller product, close in, adaptive reuse of existing structure. The numbers of those is going to be just mind-blowing over the next few years. And not just for my former employer, but for other folks in the logistics space.
So maybe some of those C buildings, if they're in the right location, are going to have an adaptive reuse. What about cost, right? We had everyone that was here listening to Carl Panetone complain about land prices yesterday, got some insight into replacement cost. How much of those costs moved, in the last year or two, including land, and what does that really mean for the support of rents, right? We're all concerned about the level of rent growth underwritings, but I think there's some support for that given the level of construction costs that maybe people don't appreciate. Does anybody have any thoughts on that?
I think that the land prices are definitely up in some of the high barrier markets like South Florida, Inland Empire, LA. We've seen this in the presentations. It's pretty interesting. They're also up in the other markets too, but obviously not as dramatically. We've seen the cost increases on the construction side, but it's varied by market. It's interesting that some markets have, and it's not just because of union or anything like that. Some markets have just had, mainly because there's not as many contractors in that market, especially in some of the secondary markets. Maybe there's not as many contractors there to bid the work. Maybe there's just a lot of activity in that market or whatever. But we've definitely seen the cost go up.
I would agree with that.
And is that driving rent growth, you think? I mean, is it?
Oh yeah, definitely. I think that clearly the markets are allowing you to push rents for that piece. You don't get all of it back, but you're getting some of it back.
That's generally true, but the other side on build-to-suits, because of the low cost of capital, you could build a building and have lower rent, so that's keeping big bulk warehouses rents lower. So that's the other side of the equation.
Got it. Excuse me. So does that mean, you guys seems like everybody's probably allocating more capital to the development side of the business than ever before, and as opposed to the investment side. Is that where you're finding value?
Yeah, our cost of capital can't compete with the foreign investment. And we're really focused on the development side right now. Right now, it's very difficult, and we can get much better returns on the development side, but that's even getting pressured because of the pricing of some of this, big bulk buildings is just driving all the yields down.
Yeah, I think what our experience has been is the inflow of core capital that can't find a home is making its way into development, right? So AEW's core fund is building buildings in Chicago. Morgan Stanley, J.P. Morgan, all the big open-ended pension accounts are quietly delivering significant amounts of spec. The spec numbers that we're tracking, the $80 million I referenced before, that's almost 50% higher than last year. So that's probably a signal to watch, is that core money is going to make it out, right? And I haven't seen, you raise a lot of core money. Are those core accounts actively interested in development? Do you think that will continue to add supply to the market at the pace it's been?
Well, generally a lot more. When the recession happened, we seemed like we were one of the few companies willing to build. Now it seems like everybody's willing to build. So there's lots of money looking to do development.
Yeah, 70% of our top institutional accounts are actually building, which I've never seen.
Yeah, everybody's doing it.
So, buildings unencumbered with vacancy, core funds building warehouses.
Well, and we're seeing, people building them again. This happened in the last '07. We saw them building them empty and just selling them.
Right,
It
so
was-
what's the spread on that deal?
Yeah,
Every developer in the room is now taking notes.
Yeah.
What do you think?
Yeah.
Is that 75? Is it?
Yeah, I think that you could easily get a 10% margin on that, so whatever that
Yeah.
works out to, on those buildings, and you might be better off than leasing it, quite frankly.
Right, but are they?
The key is, and part of why it's happening is people want newer product, high-quality
Yes,
product,
yes.
in good locations. So if you're building a speculative building in a bad location, you're not going to do well. But if you find a great location, it's a great building, it's state-of-the-art, you have a good chance of being successful.
Well, I think that we're also seeing many how can I say this politely? Many developers are pleased with the buyer rent and absorption underwriting relative to their own expectations. I think you're doing these forwards, and the aggressive projections you'll see in an Argus model are making it into the forward business.
One thing that we often see, Jim, you brought it up. There's an overabundance of real estate on the market right now, and a lot of it is groups selling out of their problem children, right? The market is so hot that you can unload Class B, B- assets at a great price, just because the market's so frothy. By the same token, you come across a lot of groups that are trying to forward assets, developments that totally max the site. Functionality of the physical asset is limited, or it certainly has challenges. You have chamfered corners, you got buildings too deep, truck courts too shallow. So again, it all comes back to functionality and long-term viability of the asset. While you can certainly forward an asset and sell it to someone for a pretty penny, on the buy side, you just have to be cautious. So,
Got it. So, excuse me. So development's healthy, everyone's doing it, but in order for those numbers to work, the duration of the leasing market has to stay, right? I mean, if you're doing a forward sale and you're expecting X premium, if you miss your rent by a month, or you get a nickel less, you still have a good building at a good yield. Right, but a lot of that depends on the durability of the leasing market. These forwards don't look so good, when there's no prospects. So, comment, if you will, across your portfolios, durability of the leasing cycle. Is this do we have 2 years? Do we have 3 years? What's driving it, and how are you planning in light of that opinion, Stanley?
Well, again, I've said it before, the fundamentals are good, and it's hard to predict the future, but right now, the demand-supply equilibrium seems pretty stable. Certain markets are better than others, but it's a good market. I mean, and we've had steady rent increases. It hasn't been off the charts. So I think one thing that's beneficial in this cycle is that it hasn't exploded. And because it's been slow, I think it maybe continues longer than it has in prior cycles. I also think there's probably less risk of it crashing because it's been more consistent. It's had probably less debt than in prior cycles.
Right.
People have been less debt, so I think it's just generally more stable now. I haven't heard many people say this, and it doesn't like people are talking about it, but people don't seem to be as concerned about world events or outside events, but that could always change the equation.
Do you think that you can jump in a second, Nick. Do you think that the fundamentals side of the business has more legs than the capital market side? Right? Do you think the fundamentals will carry us farther than we think?
Well, the fundamentals are always going to be important long term, and they seem very good right now. The capital seems really good right now too, so I can't say which one's stronger.
Very political.
Yeah.
Very political.
They are both very strong right now. I think Stanley's right. I think that this slow overall economic recovery has been good for real estate. It's kept the supply relatively in check. Everybody's portfolios seem to be 95% plus leased, is what I'm seeing. And now we're really seeing a lot of rent growth. And the question is, will that get overheated? Obviously, supply, we got to keep close eye on it, because we just said everybody's starting to develop now, and that will throw some cold water on the rent growth going forward.
Got it. Okay, well, do you have anything to add, Tom?
Well, I was going to say, it seems heretical to say it, but the discipline of the banks, surprisingly, and from a lending standpoint, has actually kept a lot of the development in check. I mean, the ratio that you mentioned before, Jim, about spec versus the build-to-suit pipeline, it's remarkable. And as a result, that supply-demand balance that Stanley talks about is really in place. So.
Okay, we're down to our last 14 minutes. So we're going to go down the line. Final opinion. If this were a baseball game, what inning would be in the capital markets, and what inning would be in the leasing markets? And these are one-word answers. They're like numbers, 5, 7. Tom?
5 on capital?
5th inning. And leasing?
7.
So you think that it's later in the leasing game than the capital game?
Yeah, I mean, specifically from a growth standpoint,
Right.
probably. I don't think it falls off a cliff, but
Chris, how many legs do we have? You don't have to talk about leasing. I didn't think
Yeah,
you lease a lot of space.
that's not my forte. I'd say we're in between games of a doubleheader, because it's an extended type of recovery. So I think
That's the best answer I've ever heard. We're in between games of a doubleheader.
yeah,
That's how you get a job at Goldman. You come up with stuff like that. Wow.
yeah.
I'm going to use that. I'm going to use that. Nick, a tough act to follow.
Yeah,
What-
I agree with him.
How can you beat that? I mean, it's so hard to tell. I mean,
Oh, no.
one word, 6 for both.
6 for both.
5 for capital, 7 for rent.
Really?
But I was.
He's
it's
going to
more one
qualify.
word,
He's
but-
going to
but-
political on me
the one
again.
thing we
You're
haven't
not
said-
running for office,
The
dude.
thing we haven't talked about, though, that I think may be a factor that's hard to quantify is I think there may be increased demand going on because of e-commerce, people
Correct.
repositioning, and because people have not done anything for 5 years. And I'm not sure how to quantify it.
Our
But I think that may be a factor that could come into play.
Our client survey, the top 35 investors in the space kind of voted, and I think I agree with the conclusion. Most of our investor base said it was 7th inning capital and 5th inning fundamentals for the reasons you stated.
Yeah.
That I think never underestimate the legs in the demand side of the business that are going on right now. So with that, I'm supposed to open it up for questions. Are there any questions out in the audience? Everybody wants to go home. Right. Well, look, thank you very much for staying for our presentation. Thanks for attending. Where's Barb David? I'm supposed to say, see you in Toronto in October.